there were too many companies in our sector trying to grow too fast with too weak of balance sheets. And by consolidating, we're going to end up with stronger financial players, with management teams that'll have more capital discipline, have lower G&A, and will be able to return cash to shareholders, which will be important for the sector. So, yeah, we feel like we led the way. In fact, we closed our transaction 2 weeks ago. Others are just announcing them now, but I think it's good for the industry.
Do you think there's going to be more deals?
I do. I can't speculate, but there's still a lot of players out there, and more consolidation makes sense to me.
Is this should our viewers and investors sort of read this as the growth is probably over? We should anticipate, these kinds of oil prices, 40 to 50, 35 bucks, whatever, for a long time. Is that how we look at it?
I wouldn't look at it that way. I mean, it's still a very difficult macro. I mean, we have recovered from the lows of the second quarter and stabilized, but we're still well below pre-pandemic levels. What I would view it, though, as this is an industry that is out of favor with investors. We hear that on your network often, in part because we have not earned appropriate returns on invested capital. We've not earned our cost of capital. And so the only way to earn above cost of capital is to be more disciplined with capital. Mike Wirth, our CEO, we think has led this way, and I think we're seeing others. And so I'd expect more focus on higher returns, less focus on growth, and that will be part of the equation of attracting investors back to the sector.
Listen, obviously you guys made a play for Anadarko. You did not get it. At this point, you're probably thankful just because the macro environment turned so violently, once that deal got done. You don't need to comment on other deals, Pierre, but I will say this. Do you think that the level of debt across the entire industry is in any way sustainable?
Well, Brian, look, we walked away from Anadarko and we took our $1 billion because we wanted to show, and Mike Wirth, our CEO, wanted to show capital discipline. And that was, you're right, in a different macro environment, but it was the same message. This still wasn't a sector that was not earning its cost of capital. So, we are very focused on capital discipline in everything we do. It's what we have to do to generate higher returns. So we're very selective in the projects that we invest in, and we're going to continue to lead in being very disciplined about how we allocate capital, whether that's in our conventional business or whether that's through acquisition.
I'm going to ask you a question. I'm sure your answer, just because, it's just you and I talking, nobody else is listening. You going to make a bid for Exxon?
I am not going to speculate about that. We respect our worthy rival. We, compete with them, and they're a great company, and we think we're a very good company too.
And what's amazing about this Noble deal, a lot of people do not realize this, okay? Everybody's looking at the Permian Basin. You guys looked, as you said, took your $1 billion, and you're looking at the Eastern Mediterranean. That's Noble's play is really sort of Egypt and Israel and Cyprus, in that region. Not a lot of people talk about it. How big is that potential opportunity?
Well, that's certainly one of the assets that really attracted us to Noble. It's a great resource. It's fully developed and constructed, so now it's generating free cash flow, and there's growth opportunities off of it. But we also like their position in the DJ Basin. They do have a bolt-on position to our very strong position in the Permian. They have some other assets that we like. And of course, we have great synergies. So this is a transaction that's accretive to earnings, it's accretive to free cash flow, and it's accretive to returns.
As you've said, the investors have left this industry. They've let it go in part because oil prices have been volatile, the debt loads, but also ESG, sustainability. I don't need to tell you this, Pierre, and what we've seen in the European companies, Total and BP and Shell, they're really trying to convert, or at least convert their story to more sustainability. How does a Chevron, an oil and gas company with gasoline stations, what do you have to do to make the sustainability story viable for you guys? And how do you sell investors on some part of that, given the world that we are in? Because it's key to the stock.
Yeah, so look, we share a lot in common with our competitors. We support the Paris Agreement. We believe the future of energy is lower carbon. But our approach to the energy transition is different from others, or some others. We're not divesting away and diversifying away from our core business to go into a business that, frankly, we don't have competitive advantage in. So our approach is just to your question, is how do we make our business, which is a good business, which the world will need for a long, long time, which has enabled great human progress, how do we make that business more sustainable in a lower carbon future? So our actions are around lowering the carbon intensity of our business, increasing renewables in support of our business, and trying to commercialize emerging low carbon technologies, all to make that franchise, that core conventional oil and gas business, more sustainable in a lower carbon future.
Shepard Smith here. Thanks for watching CNBC on YouTube.